What's a fund? What's a credit score? What's my credit score? ISAs, pensions, the Bank of England. What exactly do they do? If you also, like me, literally have no idea, then this is the podcast for you. Welcome to SKINT. I'm Connie, and I'm joined by my good friend Mik Bates, who's got over 45 years experience within financial services, and he will help us decode, explain everything financial. Listen, learn, and laugh along the way. And by the way, this is not financial advice. Welcome to SKINT. So we covered gilts.
We did.
We're now talking about a different type of debt. Corporate bonds, part of the debt family.
Exactly.
Maybe I should lead this podcast. No. Sorry, carry on.
The family debt or the debt family?
Yeah,
right.
Potato.
As the name suggests, corporate bonds are bonds, loans, IOUs issued by companies.
Well, I'm not that thick. I got that bit. Sorry, carry on.
And that's all. Well, that's not the only difference there is, but that's basically so companies from FTSE 100 companies, Unilever or Shell or whatever, as well as issuing shares, they will issue debt.
Why?
Because it's just the balance between equity and the debt is an efficient way of managing their finances.
Oh, okay.
So, and some of these companies...
So debt's not necessarily bad?
No, debt's not necessarily bad.
If you're a company, not me.
Tell me, is debt bad?
Well, for me, yes. For a company, maybe not.
Yeah, but basically what debt allows companies to do is raise money and have a better idea of what the overall cost of it is.
Oh.
Because just like gilts, they'll pay a fixed amount of interest on their debt. And then when it matures, they will pay the money back, and they might pay it back by issuing more debt, or they could issue shares, or they could have the cash on their balance sheet to pay it off.
Okay.
So the big difference between corporate bond, well, the two differences really between corporate bonds and gilts is one, the liquidity.
Hang on, in the layman's terms, what liquidity is?
How easy they are to trade.
Okay.
And the reason for that is because the government has always issued a lot of debt, and there's always gilts out there, and there's always people willing to trade. With larger companies, usually there isn't an issue with buying and selling their bonds.
No, I would quite happily buy.
But with some of this, well, you might be quite happy to.
Yeah.
But when you want to sell it, you've got to find someone who wants to buy it off you.
But that's quite a safe asset,
and some of the smaller companies, particularly smaller companies that don't have the credit. We've talked in the past about credit ratings. Yeah. Companies have credit ratings too.
No way.
And some of the smaller companies may not be what they call investment grade.
Oh, I remember this.
It's a term you're aware of?
Yes, it's a term I'm aware of. You know I'm aware of this term because I rang you up from the loo at a previous job I had. I'd be like, explain this to me, please. Sorry, carry on.
Investment grade is where the rating agencies, there's three primary rating agencies. S&P, Standard & Poor's. Moody's, and Fitch. And
I knew that.
They rate companies' debt.
Yes.
And they come up with a rating from, could be AAA for the really peak ones, down to BBB, which is investment grade. And then below that is what's called high yield debt. Are you familiar with these terms?
Yes, you know I'm familiar with these terms. But junk bonds is just basically...
Junk bonds are even...
They behave more
lower
like
quality.
Yeah, but they behave like equities, don't they? In times of market volatility.
Well, basically, the lower the rating of the company,
the more
interest they have to pay.
Yeah, and the more they act like equities. Yes, because you want investment grade. Investment grade is a good shock absorber, right, in your portfolio. Like in times of market instability, that will keep you there.
But the worst thing that can happen,
protect your portfolio.
Worst thing that happens is a company defaults on its debt. You invest in a corporate bond. Yeah, I'm not talking about a Shell or a Unilever or something. No,
that's safe.
But a small company that raises money by issuing debt.
Yeah,
they have a lower credit rating from these agencies.
Right.
They pay a higher rate of interest.
Right.
And they're also, the reason they have a lower rating is they're more likely to go bust. And if they go bust, you lose everything on your debt.
But I'm assuming the returns are higher. Potential returns are higher.
The interest rate is higher, yeah.
Yeah. So that's interesting. So if we just take a step back, just to make sure I've completely understood this, investment grade is any kind of corporate bond that's got, or any kind of bond that's got a rating of BBB and above. there are 3 rating agencies: Moody's, Fitch,
S&P.
S&P. If we go to a company like an Allied Domecq bust, sorry, that's a bad example. Well, not bust, but they got bought by someone. Anyway, it's not why we're here. If we think of about a big corporate
FTSE 100 company.
Yeah, a FTSE 100 company. That is quite safe. They're very unlikely to default. But then we've got these other kind of companies who haven't got the credit rating, and
their debt is called high yield debt.
And their debt is called high yield debt
because they have to pay a high rate of interest on it.
Okay.
And because they're not of a grade that the rating agencies think is almost certain to be there in a year, 3 years, 5 years.
But you could get lucky. What if you bought some like debt from like Fever-Tree back in the day? No. Yeah. Then it is yes. And then you could have made a lot of money.
Well, if you bought when they were a much smaller company, they'd have been paying quite a high rate of interest.
Yeah.
So they will want to get rid of that debt.
Okay.
So when it matures, if they roll it over into more debt, they'll be paying a lower rate of interest because they're a bigger company now than when they issued it before.
Who buys these risky bits of debt?
Usually institutional investors.
Why?
Because it provides a higher rate of return.
Oh, and they've got because institutional, they've got like longer.
They're well diversified. They might have 100 companies whose debt they bought.
Yeah.
So if 1 or 2 of them go bust, it's not going to make a huge difference.
No.
If it's the only one you bought and it goes bust, it'll make a difference to you.
But they've got what institutional investors? I can't think today. They've got like
funds.
No. They've got a longer time. What's the time frame?
Duration.
No, they're planning for the long term, aren't they? Institutional investors, aren't they?
They're corporate investors. They're institutional investors, but they're buying it for a fund. Mm. And there are high yield debt funds.
Okay.
And they specialize in investing in high yield bonds.
Yeah.
In order to try and give the retail investors and others a decent rate of return in the interest. And because they own a lot of different bonds, then the chances of you losing your shirt are much reduced.
Right. That anything else we need to cover on corporate bonds?
Unlike gilts, any capital gain you make on a corporate bond is not capital gains tax free.
Oh, that's that. Is that what that means to me?
Yeah.
Okay. So I will have to pay corporate capital gains.
If you make a capital gain, you have to pay capital gains tax.
Can you just remind me what's the ratio for capital gains tax?
You can make £3,000 a year of gains, capital gain, and then anything over that you pay capital gains tax. And the rate of capital gains tax depends on whether you're a basic rate taxpayer or a high rate taxpayer.
Okay.
Because it is linked to that.
Okay. I think we covered corporate bonds. Anything else?
I think we covered them.
We covered them?
Yeah.
All right. You've been listening to SKINT.